Hi, welcome to Market Technology Flex. In this video, we're talking about cyclical and non-cyclical stocks. Gotta love them. The words cyclical and non-cyclical are used to describe how closely a company's share price is linked to the economy's difficulties. Cyclical equities have an immediate link with the economy, while non-cyclical securities regularly outperform when the economy slows down. Investors have little control over the economy's cycles, but they may adjust their investing strategies to follow it. Understanding how industries are linked to the economy is necessary when dealing with economic changes. There are significant distinctions between firms that are affected by broad economic fluctuations and those that are virtually unaffected by them. Cyclical stocks. Cyclical businesses follow the broader economy's trends, which makes their stock prices highly unpredictable. Cyclical equities rise when the economy expands. Their stock values will fall when the economy contracts. They track all the economic cycles from boom to bust and back again from start to finish. Cyclical stocks are those that make or sell items or services that are in demand when the economy is prospering. They include restaurants, hotel chains, airlines, furniture manufacturers, high-end clothing stores, and automobile producers. These are also the products and services people cut first when money is tight. When consumers postpone or cease purchasing anything dispensable, the profits of businesses that produce and sell them plummet. This additionally pressures their stock prices, which then decline. Some of these businesses may even go bankrupt during a lengthy recession. Because of their ties to the economy, cyclical stocks may be difficult for investors to predict. Because it's tough to forecast economic cycles, it's difficult to guess how well a cyclical stock will perform. Non-cyclical stocks. Non-cyclical equities outperform the market when economic growth slows. Non-cyclical securities are usually profitable regardless of economic conditions since they deliver or distribute items and services we always require, such as food, electricity, water, and gasoline. Because these goods and services can protect investors from the consequences of an economic downturn, companies that produce them are also known as defensive stocks. When the economic outlook is bleak, they hold up better than cyclical stocks. While non-cyclicals don't follow economic cycles, their stock prices can still be volatile. They may not track the economy's movements as closely as cyclical companies, but they're not immune to market fluctuations. Many non-cyclical firms are affected by inflationary pressures, which can eat into their profits and cause their stock prices to rise and fall. For example, when people may not be eating during a recession, they may cut back on buying restaurant meals or opt for cheaper alternatives at the grocery store. This can hurt the profits of food producers and distributors even though we still need to eat. Non-cyclicals are sometimes referred to as quote-unquote counter-cyclicals. This is because their stock prices often move in the opposite direction of the economy. When the economy is booming, they may lag, but when it slows down, they have a better chance of outperforming. Investors who want to protect their portfolios from economic downturns may choose to invest in non-cyclicals. These companies usually have strong balance sheets and generate steady cash flow, which can help them weather tough times. However, non-cyclicals may not always be the best choice. They can underperform during periods of economic growth, and their stock prices may not recover as quickly when the market rebound occurs. To sum up, cyclical stocks are those that are tied to the economy. They rise and they fall with the economic cycle. Non-cyclical stocks are those that are not as closely tied to the economy and may do well when the economy is struggling. Both types of stocks can be volatile, so it's important to understand the risks before investing. Non-durable household goods like toothpaste, soap, and shampoo and dish detergent may not appear to be essential at first sight. Most individuals cannot wait until the next year to wash themselves with soap in the shower. Another type of non-cyclical business is a utility provider. People require power and heat for their own use and for the needs of their families. Utility firms are conservatively expanded and do not fluctuate rapidly because they provide a service that is used frequently. Another important point to consider is that non-cyclical stocks do not enjoy the same type of growth potential as cyclical equities. They provide security, but they won't rise in price when the economy improves. When highly cyclical businesses are having difficulties, investing in non-cyclical equities is a smart strategy to avoid losses. What are some examples of cyclical stocks? Stocks in this category are typically for expensive, long-lasting products such as automobiles, luxury items, and leisure. As a result, the automotive sector, consumer durables companies, airline firms, luxury goods producers, and hospitality businesses are all excellent examples. What are consumer cyclical stocks? Analysts frequently categorize cyclical stocks into consumer and non-consumer. A non-consumer cyclical is a firm that sells to businesses, governments, or large organizations and is affected by the economy. A consumer cyclical stock is one that targets individuals or households. What types of stocks are non-cyclicals? Non-cyclical stocks are those in which consumers will continue to buy the goods they offer because their needs remain constant. These frequently include everyday items like food, fuel, utilities, and pharmaceuticals and healthcare. Our key takeaways today: cyclical equities are unpredictable and follow the economy's movements. Non-cyclical equities outperform the market during an economic recession. Cyclical stocks produce things and provide services that people purchase when the economy is prosperous but cut back on when it dips, such as luxury items. Non-cyclical businesses deal with consumables such as food and apparel. When the economy is strong, cyclical equities typically go up and down, whereas non-cyclical stocks are steady producers in good times and bad. Understanding the difference between cyclical and non-cyclical stocks is essential for any investor looking to protect their portfolio during an economic downturn. Cyclical stocks are those that are tied to the economy and will rise and fall with the economic cycle. Non-cyclical stocks are those that are not as closely tied to the economy and may do well when the economy is struggling. Both types of stocks can be volatile, so it's important to understand the risks before investing. Cyclical stocks are those that are tied to the economy. They rise and fall with the economic cycle. Non-cyclical stocks are those that are not as closely tied to the economy and may do well when the economy is struggling. Some examples of cyclical stocks include the automotive sector, consumer durable companies, airline firms, luxury goods producers, and hospitality businesses. These are all companies that produce things that people purchase when the economy is prosperous but cut back on when the economy dips. Some examples of non-cyclical stocks include food, fuel, utilities, and pharmaceuticals, healthcare. These are all companies that produce things that people need even when the economy is struggling. Investors looking to protect their portfolio during an economic downturn should be in non-cyclical stocks. These stocks may not perform as well when the economy is strong, but they will typically hold up better during an economic recession. Thanks for watching. Please do help us out and like the video, share your thoughts below in our comments, and subscribe for notifications.